Professor, great to have you with us.
Thank you.
Deeply negative, meaning minus 3%. Walk us through the scenario in which this makes sense.
Well, first of all, you can't do it right now. The Fed did not prepare for it in 2018 and 2019. You need to be able to prevent people from hoarding cash, make changes to tax, legal, other things. None of these are huge obstacles that they can be done. But look at what the Fed is doing, basically buying huge swaths of corporate debt, junk bonds. Ford Motor might be paying 8 or 9% on the markets, but borrowing from the Fed. Boeing is able to stay afloat without having to have any conditions yet. If we get out of this quickly and the V-shaped recovery that feels like it's built into the market at this point takes place, no problem. But if, for example, we have a second wave of infections in the fall, maybe even greater than this one, or many further smaller waves, and this goes on for a long time, a lot of restructuring needs to be done. And you can't just guarantee every credit in the economy. You can't go to sort of a form of socialism, really, that we're tiptoeing towards. You need at least an instrument as part of this that's market-based. And if I think we were able to do deeply negative interest rate policy, it would keep a lot of companies afloat. There are others that would still need to be restructured in some way. But the fact that we've taken it off the table, I think, is really unfortunate. And you're, forced to treat everyone the same. I think it's a mistake. And I think negative interest rate policy, all the evidence I see as it comes in from Europe and elsewhere, is that it works pretty much the same as monetary policy. Normally, it doesn't fix everything. You need fiscal policy. You need all these massive things we're doing. But the fact it's not in the toolkit is a big problem.
Let's be clear, though, Professor. Basically, you're saying what the Fed is doing in terms of blanket debt guarantees at this point may not in the long run be what is best, because the recovery that you see is not going to be a bounce back recovery. Even though the stock market is back to levels we've seen a year ago, you think that a better bet is that wealth is going to be, these are your words, destroyed on a catastrophic scale. What does that look like in the economy in terms of the metrics we all know?
Yeah, I mean, we're looking at certainly the dive is in unemployment, and if we could really measure it in output, is like nothing we've seen since the Great Depression, probably on par with that. And the question is, how fast do we come back? And I'm very skeptical of the view that we're mostly back in a year even. I think it's going to be 5 years. That would be my sort of point estimate of how long it is till we get back to where we were in 2019. It took us 3 years after the financial crisis of 2008. I think this is worse. But of course, there's a lot of uncertainty. If vaccine comes along, antivirals, well, if it comes quickly, things will be much better. But the epidemiologists that I listen to, what I read is that we're maybe near the end of the beginning of this, nowhere near the end.
We may have flattened the curve, but we haven't bent it down in terms of national case counts, Professor Rogoff. And I like you, I'm very concerned that this is a longer sort of healing period than a lot of people are saying, which drives me to my next question. If you're talking about a catastrophic destruction of wealth, are you talking about a catastrophic destruction of equity prices that would take people's 401ks and carve them by a third or by half, and that we are really failing to discount for the possibilities that you describe, which is depression-level unemployment that persists, that doesn't turn around in a year even, that may last, and that the recovery may last 5 years?
Well, of course, there's some companies that are going to do very well because the ones going out of business are the smaller ones. There's going to be a consolidation. There'll be more profits eventually for the firms that are left. So this isn't an everyone loses situation. I think the tech industry, the big ones, are going to lose gain. All the startups are going under. So it's not everyone loses. I mean, there are obviously tens of trillions of dollars in the stock market saying that the combination of the Fed being so supportive and the virus maybe not being so bad, it's saying that things are going to be better. When I listen to macroeconomists around the world and I talk to epidemiologists, I don't quite see it. I hope it's right. I wouldn't advise people to pull out of the stock market. I'm not saying that. What do I know? As far as what I'm looking at in the economy, I think it's problematic. And I think going back to the Fed, I think this plan can work for a while, but it can't work forever. We could go to Europe too. Their plan of sort of keeping every worker at every firm there, that's why their unemployment rate hasn't spiked. They can do it for a few months, for a year, for 2 years. They may well end up with unemployment rates greater than ours.
The Fed, as we understand, Professor, has not actually embarked on buying any corporate debt, although they have indicated that they are willing to do so. So just by jawboning, they've accomplished a lot when it comes to the recovery we've seen in the junk markets. What's the longer term implication here? If the Fed is in it for the long run, even though it thinks it's going to be the short run, you say it's going to be the long run, and it's left holding the bag, so to speak. What is the implication of that?
Well, I mean, eventually, we're going to see a lot of bankruptcies. And just the way it's hard for the hospitals to handle everyone coming in at once, it's not going to be easy for bankruptcy courts, for restructuring. Again, if this goes on for a long time, there are going to be a lot of businesses that don't work. There are going to be corporations that have problems. That will feed it back also onto the banking system. I don't criticize what the Fed has done, given the tools that it has. I think it has done what needs to be done. I couldn't have done better. Where I think the mistakes were made was back, say, last year, when they were rethinking what their instrument should be. What should they do if something really bad happens? They prepared maybe for a 1 sigma or 1.5 sigma event, not a 4 sigma event like we're seeing.
Right.